What's up everyone? In this video we're going to be going over what ICT refers to as advanced market structure and how we can use this to increase our win rate. So firstly, we need to start off by defining what makes an intermediate time high or low. In this example we use a high. So there are two types of classifications for this intermediate time high. One of them is where the high has two short-term highs either side of it. So as you can see in this screenshot from ICT's 2022 mentorship, this intermediate term high here has a short-term high and a short-term high here, which automatically defines it as an ITH. And then the second definition is a high which rebalances a fair value gap. So we have this fair value gap here in the example after breaking down the structure. It comes up, price comes up and rebalances it and moves away. Once price leaves this high, that automatically is defined as an intermediate term high, and we go about market structure in that way. So, using the replay tool on EURUSD, I wanted to show an example of how we can use these different classifications of highs in context and actually determine where to place our stop loss so it doesn't get hit. First of all, I want to note this short-term high here. As we know, it's a short-term high because we don't have a high this side below it, but we have one here, so which automatically made this a short-term high. When price rode up and then broke lower, put in a short-term high, broke further past this point, this up here automatically became an intermediate term high because of the two short-term highs either side of it. As you know, we're looking for fair value gaps to enter off of. That's what I look for, and specifically intermediate term highs in fair value gaps. Because on this short-term high we didn't mitigate this fair value gap, that's the reason it was a short-term high in the first place rather than an ITH. However, when we broke lower, price came up and actually mitigated it this time. This automatically became an intermediate term high. So now that we've mitigated the fair value gap, let's drop down to a lower time frame and wait for a shift of market structure before looking to enter. As you can see here, this was our short-term low, which got broken with speed and decent distance, as you know I look for. So as I saw this happen, I'm scouting for sells off of this fair value gap with my stop loss above the intermediate term high up here. If we run the clip lower, as you can see we broke down much lower. Again, now my attention has shifted to this fair value gap here. I'd like to see this mitigated into, and that would be my entry. That's where I would sell from, sorry. Probably down, take partials at this point, and then full TP down here. So we'll mark this out as our target, and of course my stop would be above the intermediate term high up here. That would be my sell right there. So if I take my sell tool, stop above the intermediate term high, TP at 1 to 1.5. As you guys know, I like to aim for low hanging fruit rather than huge TPs. Like technically you could aim down here, but a 1 to 3.5 is just unrealistic. That's not how I trade. If we play it on from here, as you can see, beautiful reaction. Of course price would have came to sell side liquidity, but we don't sleep on moves like that. We don't lose sleep over moves, I should say. So moving on to what happened today on EURUSD. So DXY has been consolidated and actually moved quite nice today. However, right here it was consolidating before reaching into this FEG it seems to have now. But it was consolidating earlier, so you know I look for exotic pairs to trade. So I went to EURUSD down here and saw that we had a clean reaction off of this M15 order block and then price did exactly what I looked for. It filled an imbalance here, moved lower, filled another imbalance before moving lower, and I actually outlined what I wanted to see from my mentorship. I have the pictures here. So the first one, as you can see, we're at this point here, just after New York Open, and I said I want this low to be broken and then possibly use this as an order block entry for our draw and liquidity, which is some daily equal lows. So this is a perfect example of how we can use this intermediate term high here as our stop loss, and it shouldn't be violated, because in market maker models, which this is a market maker model, sell model to be specific, we want to see up close candles not violated and intermediate term highs, which are put in obviously when filling the imbalance. We don't want to see them traded above. So I knew initially this shouldn't be traded above, and as soon as we came into this order block here, I took my entry and I aimed for a 2R. So I had my stop above the intermediate term high, as according to the algorithm it shouldn't be violated. I had my TP about here, so 1 to 2.28, sorry. And that was a perfect trade and perfect example of how we should never have our stop loss in the wrong place. Once you understand how intermediate term highs and lows are made and the difference between a short term high and these highs, then you should never really have your stop loss in the wrong place. And look, I outlined it here, and then at this point we had it traded into, look how the bodies respected the order block as well. So they traded in, I was putting my sell here because of the sell limit, the body's closed underneath the body of this order block, and then we ran down and took out my target. So on this final example in Euro, I just wanted to show how intermediate term lows and highs can also be used to signify strength or weakness in a market. So on Euro we had this 15-minute fair value gap in a premium, or discount I should say. So reached back into it down here, and then once I saw this, dropped down to the 1 minute chart, and then we reached into it. This is in London kill zone, by the way. Broke up above, and then notice how we didn't get a market structure shift, so there's no short-term high which got broken here. If it had rallied up above this, like so, and then we would have took an entry here, but we didn't break any high, so price just came up and then filled this fair value gap here. As you all know, as I described earlier, these, we just group these together really. This in particular is an intermediate term low now, and as you know, that shouldn't be violated, or in this sense this should show strength in the market. Because we haven't ran back down and we filled the imbalance and moved off of it, that shows weakness in the market now that we've put the intermediate term low in, even without breaking structure. So eventually when we did break structure, notice how this order block here once rallied above these highs, this order block held and price rallied again, and then eventually filled the imbalance, rallied some more and kept going until we reached these highs. So that's again a perfect example of how if we have no structure broken but price comes back and rebalances an imbalance left, it signifies that you're probably on the right side of the market and you want to continue looking for buys or sells depending on which you have in mind. So I just thought I'd end the video here on that example, and if you have any questions be sure to leave them in the comments. I'll be replying to any comments. Any inquiries, make sure to DM me on Instagram or Twitter. It's the same as my YouTube, and make sure you like and subscribe, support the channel, and I'll see you again in the next one.